Hello and welcome to episode 430 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, welcome back to the show. How are you doing?
Well, I've just had a realisation, Andy, that I think it must be within weeks. You and I have known each other for exactly 20 years. So that's quite an anniversary for us. And look at us now doing a podcast together. Who would have thought, Andy, when I rocked up and you took me out for lunch on my first day at that particular job, that we'd be doing a podcast together 20 years later?
That's quite nice. You've sprung that on me, because letting people behind the curtain, sometimes where you have a chat before we come onto the podcast and we've kind of chatted things through what we might be talking about. I didn't know that was coming, and I'm quite excited.
He's smiling. He's glowing after knowing that, Andy. I think it's a blessing, not a curse, that you've known me for 20 years. But mentioning the podcast, who would have thought we would be getting reviews like the one you're about to read out from UK Hazel?
Yeah, that's right. We had a brilliant review come in with the title, "My Absolute Favourite Podcast Ever." And Hazel goes on to say, "I've been listening to the podcast for 5 years and have listened to every episode. I'm currently in Samoa, and I like to think that this show has given me the financial wisdom to continue my dream of travelling for much longer than if I'd never come across it."
I love that review, because we love getting your reviews in, because it is very motivating for us. And okay, it does also help us on the podcast charts, but it's very motivating, like I say, and particularly that one, because it's slightly different angle. It's enabling someone to continue travelling. So that is fantastic. It's not just about them building their wealth. So thank you for sending that in. UK Hazel, we would send you a Money to the Masses mug. In fact, we will do if you want us to, and claim your mug, but we need to know where to send it, because you could be probably anywhere in the world right now. So if you do want that mug, then do get in touch, damien@moneytothemasses.com. We will arrange for it to be sent out to you somewhere in the UK, preferably.
And of course, Damien, that's assuming we're able to actually get back to the office, because again, letting people behind the curtain, we're going out for a work summer get together celebration. We like to do it every year, and we're doing an escape room, and I'm very excited about it. And I am slightly worried we might actually get locked in. Is that what happened?
Yeah, so I've done one before, and we did manage to get out of the room, but I think they were quite generous in terms of we completed it. I think we'd run out of time, but I think they wanted us to complete it, so they were helping us along the way. So, yeah, we are hoping that we'll get out of the room. We're particularly reliant on Joel, because Joel, if you remember, when we went and did our pub quiz recently, Joel was the star member of the team. I don't think we would have won it, let alone come in the top half of the competition, if it wasn't for Joel. So if we're not here next week, then we probably are stuck in a room somewhere with no aircon on a very hot day in central London.
Okay, so let's get on with the pod then. So what have we got coming up this week?
So on this week's episode, I'm going to be talking about an alternative to the 4% rule. So on pensions into retirement, the 4% rule is a rule of thumb that's been used for decades as a potential sustainable rate of withdrawal if you want a retirement income. I'm going to talk about an alternative method. Following that, I'm going to be talking to Harvey about developments in the insurance world for children, which if you are a parent, that'd be particularly interesting. And finally, Andy, you're going to be doing a piece on direct line overcharging, but also rules that consumers need to be aware of when they are renewing their car and home insurance.
Okay, so which one of those are we going to start with this week?
So I want to start this week's show by talking about an alternative to the 4% rule. So the 4% rule was created by Bill Bengen, a couple of decades ago, and it's a rule of thumb that's used to provide a sustainable retirement income. So it's often applied to pensions. So the idea behind it is that if you withdraw 4% from your portfolio as a starting point, so let's just say, for argument's sake, you have £1 million in a pension pot. If you were to take 4% in the first year, so that would be £40,000. You then each year increase that fixed £40,000 by inflation. And as that goes along, that should give you each year an inflation protected income stream, but also that should be sustainable up to 30 years. So that was the original idea of the research. So you should be able to get a sustainable income that could last 30 years. It means you wouldn't run out of money. Now, we did do a podcast piece, episode 210 of the Money to the Masses podcast, where we looked at debunking that rule. So the results of that were, broadly speaking, that the 4% rule assumes that you're going to have 50% shares and 50% treasuries. So you're looking at 50% equities, 50% fixed income, and it would produce that sustainable income stream that increases with inflation over time. But subsequent analysis shows that actually a more sustainable rate is somewhere between 1.7% and 3.6%. But if you want to have a 90% chance of not running out of money at all in retirement, then you need to look at something like 1.8% as the starting point for withdrawals. So that is one method, but there is an alternative method. If you are looking at periods like we had during the pandemic when the markets crashed, say 20%, that's what we saw in most equity markets. The problem with the 4% rule is that during periods where we have market volatility, if the portfolio falls, then you are taking, in my example, I said £40,000 to start with, which is increasing over time with inflation. Technically, it can decrease if inflation falls and it actually becomes negative, so we get a bout of deflation. But if you keep taking that fixed amount that's slowly increasing, when the market falls and your portfolio falls in value, then you're taking a bigger percentage chunk. And therefore, that means that your money is more likely to run out over time and it won't last your whole retirement, for example. So that is an issue with that 4% rule or variations of it. An alternative is to take a fixed percentage. So this takes into account market fluctuation. So let's say you took 4% every year. So if your portfolio went up, you took 4% of that new value of your portfolio. So therefore it could increase. Let's just say your portfolio after taking money out after year one increased by 10%. Let's just being optimistic here. So 1 million goes to 1,100,000. That would mean that your second year income will increase to 4% of that number, which is £44,000 in year two. Equally, if the market value was to fall of your portfolio, then you would take less than the £40,000 you took in year one. So by doing that, you would never run out of money because you're always just taking a percentage. But the reality is for people who want an income stream, such volatility in their income stream isn't useful because most people have costs that are relatively fixed and that increase over time. So that's why people would like the 4% rule. But there is another alternative that exists. And Vanguard did some research that relates to this alternative dynamic spending method. So what I wanted to do today was to look at that because Vanguard did a new white paper about this dynamic spending method in relation to the market slump that we had during the pandemic. So how dynamic spending works, it varies the amount that you spend each year because it has some reference to what's going on in markets. Now, if you use a spreadsheet, you can start to use that to work out some of the numbers. And if you're listening to this as an audio only podcast, then I have created a YouTube video, which will be up in time where I do show some numbers on screen. So if you find the numbers a bit mind-boggling when you listen to it, then do keep an eye out for that video because it will be up and it will show you the numbers. But I am going to give you a tool later on that exists that you can use to work out numbers yourself. So if you do use something like a spreadsheet to work out some of the numbers, then dynamic spending works by taking a portfolio size at the start. And I'm going to just assume £1 million because it makes the numbers easy. So under the usual 4% rule, then what would happen is you would have spent, if I assume 4%, you would have spent £40,000 a year. And in year two, if we assumed an inflation rate that year of 2%, then your spending in year two would go up to £40,800, irrespective of what your portfolio was doing, whether it gone up or down. And of course, that's where you can get that sequence of event risk, where you can have markets go down and you take a large amount of money from your portfolio. It's a fixed amount, but percentage-wise, it can be significant, and that can then impact the sustainability of your income stream into retirement. So that 4% rule of £40,000, yes, it's inflation protected over time. Now, if you were doing the fixed percentage of just 4% every year, whatever your portfolio is valued at. So you start at £40,000 in year one. If your portfolio grows to £1,100,000, then you've got £44,000 in year two. But if you change the numbers, and if, let's say, for example, you had the portfolio drop to 900,000 in year two, then what would happen is your fixed percentage of 4% would equate to £36,000 as your income in year two. So that's a significant drop. So most people wouldn't want that kind of volatility because it reflects the volatility you're seeing in markets. But if instead you use a dynamic spending rule, the way it works is it gives a ceiling and a floor to the amount that you can take out in a year, and that ceiling and floor number that you calculate is with reference to your portfolio size, so what's going on in markets. Now, I'm going to tell you the numbers, so like I say, you might have to pause things and re-listen to it to get the numbers in your head. But what you do in order to work out the spending under a dynamic spending system is that you take the amount that you would have got under the 4% rule. So do you remember when we were talking about it, you'd have the 4% rule, you take £40,000 in my example in year one, it would increase with inflation of 2%, I'm assuming, to £40,800. That's your starting point. What you then do is you then create the ceiling number, so that's a maximum you can take. This is Vanguard's numbers that I've looked at in the white paper, which we will put links to in the notes of this episode. The 5% ceiling, so you add 5% to that number, so 5% on top of that 40,800, that gives you this ceiling of £42,840. In the paper that I looked at, Vanguard used a floor that was 1.5% below that 40,800 number. So there are other papers I've seen when they use 2.5%. But if you use that number of a floor, what it means is that even if your portfolio tumbles in value, then the minimum that you can take or will take is £40,188. So you can see that it's with a reference point of the 4% rule number, but it gives you a higher amount if your portfolio does very well, but it gives you a lower amount if the portfolio drops in value. But unlike the fixed percentage version, where you're literally taking a fixed percentage of your portfolio, what the dynamic version does is it does that, but it limits the amount that you can take if your portfolio does well. So it keeps some money in the pot that can help you in the future to maintain that income stream. But if your portfolio drops, it reduces your income slightly, but it means your portfolio again will be more likely to produce a sustainable income stream in the future. So you've got the ceiling and the floor. So all you've got to think about, there's two boundaries. And then what you do to calculate what your possible year two spending number is, you take the fixed percentage rule that you were using. So that's the one where you just take 4% of whatever the portfolio is. Then if that's your percentage 4, then if the portfolio has gone up to 1.1 million, I said, then that percentage of 4% is 44,000. And you look at the ceiling and the floor. And if it's between those numbers, then great. If it's not, then you would take either the ceiling or the floor. So in this example, £44,000 would have been the amount you would have taken. But the ceiling that I've calculated is £42,840. So that means that's the most I will take. Now, I'm going to tell you how you calculate ceilings more easily, because I've just given you an example there. And as I say, I've run some numbers that people can see if they watch the YouTube version of this. But the key message is that this dynamic spending rule, what it's really doing is getting a bit of best of both worlds. So it's taking the idea that you might be able to get more if your portfolio is doing well and increase the amount you take, but not unsustainably. But if your portfolio falls, it's actually reducing it, but it's not reducing it unrealistically. So you don't have wild swings in the amount that you get each year. There's an element of stability that's going on. So what is interesting is Vanguard then took the idea and they looked at it with reference to what was going on in the post-pandemic period. And there's a paper that we'll link to, which you can read through at your own leisure. And they looked at the impact of using different methods. So they put aside the fixed percentage method. They just looked at, in particular, the dynamic version and the 4% rule that we all know. And if you go and look at the numbers that they crunched, they looked at the market expected return. So this is something Vanguard does. It looks at the potential returns for different assets that they assume in a portfolio. Now, you've got to think that when the market crashes, then the expected future returns of those assets after a crash actually goes up slightly. So if you think about it, it's almost getting something on sale that if you see the market drop, it becomes good value. Your expected annual return in the future can increase because you've gone from a higher price to a lower price. And if things fundamentally pick up, it does tend to suggest that you will see a dynamic where that expected return goes up. So it takes all that into account. What you need to focus on is that in their paper, they worked out that if somebody had £1 million, they say dollars, but it doesn't really matter, $1 million, and they have an asset mix that is broadly 50-50, so 50% equity, 50% bonds, You would have an income stream before the pandemic, which was sustainable, of $52,000. Now, if you just use the old style 4% rule where it increases slightly with inflation each year, the sustainable amount was $45,000. Now, after the pandemic, taking into account to changes in expected returns of different assets, they worked out that the sustainable base case, this is for dynamic spending, that method of fluctuating your annual income within limits, that sustainable amount had dropped to 45,600. So it's gone from 52,000 down to 45,600 a year. Now, under the 4% rule where your amount goes up with inflation each year, then that had dropped because of the pandemic from £45,000 a year as a sustainable income to 40,800. Now they then looked at other variations and scenarios of the most likely, looking at the optimistic outcomes and the pessimistic outcomes. But what it really is, the takeaway on this is that the dynamic spending method allows you to take more upfront as a starting income. Now, following a crisis like we had with the pandemic, the sustainable income levels under each method, it remains higher under that dynamic spending method that Vanguard likes. So the numbers are available in the white paper, which we'll put a link to. They also looked at the percentage chances that you would have money when you get to later in retirement. So let's look at the probability of success in times of crisis. They looked at, with a dynamic spending method, you'd have a 91.4% chance of having some money left over after a 30-year period. That compared to 65.8% when you use the normal 4% rule. That was before the pandemic. After the pandemic, with a whole range of assumptions, then that had dropped to a 66.2% success rate for dynamic spending and also 35.8% for the 4% rule method. And those assumptions in that were that you wanted $50,000 a year, so £50,000, and you wanted to last 30 years. So what was the chance you had money left over? You can find the full information if you want to via the link in the notes. So the big takeaway from this part of the podcast, there are other methods other than the 4% rule and ways that you can dynamically change your spending to make your money more likely to last longer and actually give you a slightly higher income at the start. Now, this is all based, of course, on various assumptions that you can see in the notes if you want to look at them. And of course, history doesn't always repeat. And that's one of the things. You look at the 4% rule, people have looked at that and debunked it. People will look at this research. Has it been applied to historical cases? All historical cases, there will be people who will pick holes in it. But what it does do is it gives you an alternative method. Now, there are people who are going to be listening to all that and say, I like the idea of having these limits. How do you work them out? Fortunately, there is a website called ficalc.app, which you can find. Put a link again in the notes, and it will do various different calculations, different methods. So you can go on there, put in your own numbers, your own term, whether you want to use the 4% rule, whether you want to use, for example, the dynamic spending rule that Vanguard talks about. You can use it and it will work out all of the numbers for you. So it will give you something to work with. So play around with it, have a look at what it produces. Obviously, you've got to just take it with a slight pinch of salt, really, because it isn't anyway guaranteed, but it will give you something that you can work with. And of course, don't forget there are other alternatives. For example, you can just live off the yield of your portfolio rather than taking chunks of it at a time. So let's say, for example, you have a portfolio of shares or equity income funds. They can produce an income stream that can keep pace with inflation. It needs a lot of research because obviously you've got to look at good, reliable dividend payers or funds that have a reliable history of paying out income year on year. That would obviously mean look at investment trusts. We do a lot of research on that on 80/20 Investor. Of course, we'll put links to that in the show notes so you can take out a free trial if you wish to. So there you go, Andy, an alternative and interesting way of creating a sustainable income from investments and pensions. Okay, so I'm going to bring Harvey onto the show. Harvey, as you know, writes lots of different content for Money to the Masses, covering all things like mortgages, but protection, so life insurance, income protection, critical illness, that is really Harvey's specialty. So Harvey, welcome to the show.
Thanks for having me back, Damien.
So what we're going to be doing today, has been interesting developments in the insurance world in relation to children. So if you are a parent and you're not even thinking about insurance, this is worth listening to because there's some tips that we're going to be talking about as well. So Harvey, there's been interesting development. So what is changing in the insurance space for children?
Well, what's happened over a period of time now, Damien, is that we've seen more and more insurers emphasise the covers within their policies that are mainly designed for adults that have benefits for children. So you may get something that's integrated within a policy, or you may get an additional type of benefit that you can add to a policy and it covers your children. Mainly the area that we saw it in to begin with was critical illness cover. So it's where somebody's diagnosed with a serious illness, something like a cancer, a heart attack, a brain tumour, and for children, specific critical illnesses like bacterial meningitis. But what we've seen is quite an array of insurances develop in a way that they're targeted towards children and actually give parents who perhaps either can't afford cover for themselves or have reasons why they wouldn't qualify for the cover themselves, give them the opportunity to buy cover for their children. And that's really what we want to talk about today.
So what types of policies are we talking about?
So largely, we're talking about critical illness cover, which is a policy that's designed to pay out a lump sum of cash if you're diagnosed with one of a number of specific illnesses. The illnesses do change from one insurance company to another, but largely they're things like cancers, benign brain tumours. In children's cases, it might even just be something like type 1 diabetes, which we've seen an uptick in the number of children being diagnosed with that now. So it might be a concern for parents. But we've also seen some expansion for children in the areas of health insurance. And there's a specific new policy that's come out that is a standalone policy that's only for children. And it's focusing on things like accidental things, so fractures, hospitalization, as well as a few of the serious illnesses that you would see covered under a critical illness.
So we're actually talking about standalone policies now for children that are beyond things like critical illness. We're seeing it in health insurance as well. So the options for a parent are that they could take out some of these policies themselves, and the children historically would be able to be named on there with some of the benefits. But now we're seeing these policies come out that are aimed at children. But what sort of prices are they roughly?
So the new one that we're talking about today, which is the MetLife Child Shield cover, it's not available across the board. It's only available through certain brokers who actually helped give MetLife feedback in order to design the product, which kind of alludes to the fact that it's been designed with customers in mind and what parents are worried about, is £6 a month. So at the basic level, it's £6 a month. At the enhanced level, it's £11 a month. And that premium covers all of your children, however many children you have. So you're not paying per child, and will pay out every time an event happens. So whether it's a fractured bone, whether it's a hospital admission overnight, or it's one of the more serious conditions like the cancer or the type 1 diabetes or the bacterial meningitis.
So let's talk about scenarios, because I know personally that when I've looked at my own family, that sometimes when you look at things, maybe it might be medical insurance, that often you will look at it for other people before yourself. And so that is a motivator. So it might be for your partner. We go back to an episode we'll link to where Emma, who we both know, talked about the benefits from different insurance policies she had when she got diagnosed with cancer. And I think that really drove home the benefit of some of the insurances like health insurance, should you have a health issue. So in your view, who do these sort of policies benefit? What type of people?
I think what they do is they do reach out to people who have perhaps already suffered financial consequences of maybe accident-prone children. You know, we can laugh about it, but some parents, like you and I, will know other parents where their children just seem to have falls on a regular basis, break bones and do these sorts of things. So parents like that might actually think, do you know what, just I need a bit of fracture cover so that if I'm self-employed, perhaps I'm a hairdresser and I'm losing business because I've got to take my child to the hospital to be seen, and that's taken a while, and it covers the cost of those things. Because a little bit like what we discussed with Emma when she came on the show and talked about her experience, she was paying for somebody to wash her hair because she had had breast surgery and couldn't really raise her arms to wash her own hair. And these are things that we perhaps think about less when we think about accidents and illnesses, is the consequence, the financial consequence of these things. And they might be minor, but actually they do have an impact on people. And it can be helpful to perhaps get a payout for something like a minor broken bone, which on this type of policy would be £100. If you go for the enhanced policy, could be as much as £200. If you break a major bone, the policy pays out £300 per break and could pay as much as £600 if you go for the enhanced version. So that money could be the difference for, say, a single parent that has to pay for childcare for the other children whilst they take that child to the hospital, or that parent, if they're self-employed and are going to actually lose money because they've had to deal with something that was unexpected and accidental.
So I think that sums up really well the reasons why people might think about it. Because I know there'll be people out there listening to the podcast thinking, but why do I need to insure my children though? Because I would just be looking after them. But that is some good examples. And I suppose, as you said before, there may be people who can't get cover for themselves. So therefore they can't even have their children as an add-on to a policy because they don't qualify, or they may have their own protection policies in place that they don't want to disturb or don't offer their benefits. So the other thing we talked about off podcast, and I asked you, is that one of the real benefits at the moment, I know there's lots of people out there who are worried about the NHS, the waiting times, unable to see their GP. I mean, I count myself among that, like lots of people, very difficult to get a GP appointment for anything, even if it's just minor. And policies like health insurance, life insurance, a lot of people have these benefits through their policies at work. They might not realise that they allow you to have virtual GP appointments. So you can go on an app, you can ask for a virtual GP appointment. They then ring you up when you specify, you have a conversation with them. They can actually prescribe medicines to you, which you will have to pay for. And if they're for a child, you'll have to pay for them. It's not covered under the NHS, but it is really useful. I've used the services myself to be able to get referrals on these policies that are standalone for children. Do you get those benefits as well?
Yes, you do, in a word. It's a really, really attractive proposition to have access to virtual GP appointments. I think that there isn't a soul in this country that hasn't had some sort of experience, even if it's secondhand, in struggling to get an appointment for something at the GP, especially if it's something that's low level, chronic, perhaps just bothering you, but isn't urgent and you're not going to be seen urgently by your doctor. So you might just be left waiting. And I think as much as adults, we can sometimes be okay with waiting to see a GP. I don't think many parents are happy for the children to carry on suffering whilst they wait for a GP appointment. I think most people would want their children to be seen straight away. And actually, it can give you some peace of mind. So sometimes seeing a virtual GP might not solve the problems because your child might need a physical examination. But I was discussing with you earlier an event where for my own child, I couldn't see the GP, but actually what the virtual GP did was send a note over to my GP surgery and said, I've consulted on this case. Would you please see this child as a matter of urgency? And that's bumped my child up where I can convince the surgery to, because a GP has had that consultation with me. And it's also a service that we know many people would be happy to pay £6 a month for, just that. So it's actually going above and beyond to then have the fracture cover and have some serious illness cover wrapped into a policy that also gives you access to the virtual GP service.
So when you put it like that, there are lots of people out there who probably would, if they could afford to, pay £6 a month to make sure their children could get access to a GP. This is a free benefit on a product that's what the cost is. And I have to say to people that to have a virtual GP appointment is free. It doesn't cost anything, because you've got to think the insurance providers want people to see GPs because they don't want people to make claims ultimately. So they can have people seeing GPs. It stops problems becoming worse. So the video consultation costs you nothing. And so it is just a free benefit that you may have already on a policy, like a life insurance policy, like a company health insurance policy. Do make sure that you take advantage of them. We did a podcast previously on the topic, which we'll put a link to in the notes of the show. And I think now they're becoming even more important. So before we move on, Harvey, to alternatives, the MetLife policy that you mentioned, I know there'll be people that are interested. I mean, what are the qualifiers?
So you can have as many children as you like covered under one policies, and you can have a policy each. So if your parents and I have a policy and my husband has a policy, it's possible that both policies would pay out for the same child fracturing themselves. So you can have two policies. You can cover as many children as you like. The children will be covered from birth until they're 22. Quite interestingly, children can be covered even if they don't live within your household, which kind of extends it to children who are maybe going off to university. And we all know that those first few 2 weeks of Freshers Week can cause accidents and things like that. So they're still covered even when they're not living at home up until the age of 22. You can cover children in most settings. So whether they're your children biologically, or you're their legal guardian, or you're a step parent, or they've been adopted, so children in most of these situations will be covered by the policy. And the policy just keeps rolling. I quite like the aspect of the premium not changing, because I think that's one thing that people worry about, is something that was affordable to them when they started it then becomes unaffordable to maintain. And it's quite good to know that it's a flat fee that won't change. It's probably worth bearing in mind, Damien, that there are a few alternatives to consider. So when it comes to thinking about our children and their health and giving them access to healthcare, but also, payouts that might actually compensate us for lost time at work and things like that, then critical illness cover is something that you should look at. It will have a longer list of illnesses that children are covered for within those policies. So they're slightly more comprehensive than this policy that we're talking about, but maybe more expensive. There are a couple of insurers out there who will allow you to have children's critical illness cover, even if you're not buying adults' critical illness cover. So say you're an adult and you have an illness or a condition that makes it difficult for you to qualify for critical illness cover. You may not be able to get it with some insurers, but other insurers would allow you to cover your children separately, even if you haven't bought cover for yourself. So that's worth looking at, and we'll give you a bit more information about that in the notes for this episode. And then health insurance. I think health insurance is something that more and more people are interested in looking at. I think that with the waiting times on the NHS, I think most people would like that access to healthcare that they can control the timings of, but also get speedily looked at if it's their children. And there are policies in the market now for children only. So even if you don't want to pay for private health insurance for yourself and you're quite happy waiting for the NHS and you think it runs a good system for you, you may want cover for your children. And there is a way to do that too. And the company that provides that is one that we've reviewed, and we'll put that in the show notes too.
So that's brilliant, Harvey. So to summarise that then, you have got a range of options now for parents if they want to take out something like the MetLife policy, which is a serious illness and accident cover. There are the health insurance policies that you mentioned too, we put a link to. General Medical is a company that does that. And of course, you do have life insurance benefits on some life policies for children. So if you are interested in any of that, then do make sure you speak to a specialist broker. We'll put a link in the notes actually to such a broker where you can have that conversation with them if you are interested in exploring this in further detail. But I hope that we've answered the question as to why people would even consider doing this as well. And it's not necessarily expensive. I think people will be surprised at learning that.
Great stuff. Thanks ever so much, Harvey. Right, let's get on with the last piece of the podcast then. And we are talking about insurance companies, specifically Direct Line, as it's been reported that they are going to have to redress their customers to the tune of £30 million. And that's because it has inadvertently been overcharging their existing customers for their renewal price on car and home insurance. Now, the FCA brought in some new rules last year where they implemented a ban on the so-called loyalty penalty. So on the 1st of January 2022, it meant that insurers could no longer charge existing customers more than they can charge new customers to renew their home or motor insurance. And so it seems Direct Line has flagged this. They've realised that they've made significant errors. They've done what they call a past business review. And in a statement, they've said an error in their implementation of the rules has meant that their calculations for their equivalent new business price for some customers failed to comply with the regulation. And here we are now, they're having to pay their existing customers around 30 million in order to redress those errors.
So obviously Direct Line is a big insurer. It's well known from its advertising for saying that they aren't on comparison sites. So there is an element of loyalty that exists with that brand. And so people who listen to the podcast who have had car and home insurance with Direct Line or may still have it, then they'll be wondering, are they impacted? How do they find out? So what do they have to do in relation to this news?
So ultimately nothing. What they've said is that they'll be using the information that they have on file for you. Obviously, GDPR means that people can select certain ways of being contacted, and they'll use all available avenues to trace the people involved, including using third-party data suppliers. And so if you are affected, you'll be refunded the difference between what you have paid and what you should have paid as a new customer. Plus, interestingly, they're going to be paying an additional 8% interest, and people will be paid either by bank transfer, or if the insurer doesn't have your bank details, they will be sent a check.
So we bring that to the podcast listeners because you may be impacted, but it really goes to serve as a reminder about these rules because a lot of people won't be aware of them. You will be aware that Andy was specifically saying car and home insurance in relation to the rules. So the rules are that an insurer can't charge existing customers more than new customers. And so that is a positive for consumers, but it doesn't mean you don't have to shop around. All it means is that you aren't going to be charged more than a new customer. But if those prices aren't competitive, then that doesn't mean you're going to be getting a good deal. So still shop around, look for the best prices, use whichever comparison sites that you like out there. In fact, we will put a link in the show notes of this podcast because there are people out there who want to support the show. There are lots of ways you can, and we are terrible at telling you how to do that. There are links through to comparison sites that you can use whereby you can support Money to the Masses because obviously it is an affiliate link and it works in the same way as the likes of Money Saving Expert and it doesn't impact the price that you pay. So if you want to support the show and you want to compare prices, then feel free to use that and we'd appreciate it. But the other thing to take away is that remember these rules because if you are getting a renewal through the post and you are comparing prices and you do think that somehow your price is worse than somebody who is a new customer for car and home insurance, it doesn't apply to other types of insurances, which I wish it did, but it doesn't at the moment, then do challenge your insurer because it could be the prices you are comparing aren't like for like, but clearly as we had in the case of Direct Line, there may be instances where there is a failure to apply the rules correctly. Now, there may be people out there who sit there and look at deals and sit there and go, well, if I go to this particular channel, then these people are getting a particular incentive. Why am I getting that incentive? It may be you get a cuddly toy. I'm not going to name the brand that often does these sorts of things. They are technically incentives, but the rules don't apply to comparison sites. So a comparison site can offer you an incentive as a new customer that an existing customer won't obviously get, but the insurers aren't allowed to. So you will find that there may be better deals as such when you look at it in the round for new customers, but it's because of the channel they've gone through. So bear that in mind as well.
Okay, so that's it. We're done for this week's podcast. Don't forget to please do review the podcast. We've read one out at the start of the show. It gave us all a real happy bounce. You could do the same and you can win yourself a Money to the Masses mug for doing so too. And there are other ways you can support the show, of course. If you haven't done so already, please do follow our usual social channels. We're on Instagram, Twitter, or X as it's now known. We're on Threads as well. And of course, you can take a look at the Money to the Masses Facebook community group. There's always lots going on in there. It's facebook.com/groups/Money to the Masses.
And also do subscribe to our YouTube channel. We put out regular content on our YouTube channel. In fact, most of the podcasts are filmed. And you can see sections of those on the YouTube channel if you want to watch us doing the podcast. But also we produce extra content. For example, this week I've done 3 pieces on the best switching offers for current accounts, best credit cards, best savings accounts. We do product reviews. There's sorts of things that don't make it onto the podcast because they are not evergreen. So do make sure you subscribe to our YouTube channel.
And so that's it. We're done for this week. Until next time.
Until next time.